we've seen the shilling gaining some ground after, having lost some momentum to fall to a new low in yesterday's session. Still sitting under extreme pressure, though. Let's run through some of the factors coming to bear, because obviously we've got global factors standing front and center.
Well, it's true that it was being affected by partly the global crisis and partly internal factors. It's been on the back foot for a long time now, and I think part of it was caused by some corporate demand that filtered into the market. And now that coupled with the global crisis going on, the concerns on the global economy, it fell obviously to these levels before retracing on the back of a bit of position squaring and profit taking as well.
Of course, now we've got the unit sitting in uncharted territory. Its future direction very much dependent on what the central bank, and the steps it might take to support it is moving forward. What do you actually see needing to happen? Because there's been a lot of controversy around the central bank and its measures and the kind of to and froing we've seen in monetary policy over the recent past.
Well, now it's looking more and more likely that the impact may not be immediate. Whatever action they take may not have immediate impact, because on one end, the MPC that was convened last week came with less than market expectation of 75 basis points against a consensus on the market of about 200 basis points. So that obviously poured water onto the shilling. Secondly, they came into the market this week with some reverse repos. And by injecting liquidity into the market, obviously that was taken to be negative for the shilling. So up until they maybe hike the rate aggressively to a level that will make it attractive to hold the shilling, I think we'll continue seeing a weaker shilling going forward.
So where we stand at 7% right now, what's market consensus in terms of where that interest rate should be standing in order to attract foreign investors and dollars towards the Kenyan markets?
For a start, I think looking at where the inflation rate is, anything close to the inflation rate or above that would be reasonable. I know there are concerns about jacking up the rates at once, but if an investor is looking at a return, they obviously would be concerned about the level of inflation in a country. Mm-hmm. Now, coupled with the global economic fears, no one would be in a hurry to come and invest just because we are showing double-digit interest rates. So I think it has to be really high, in my view, to attract anything. And also, some of these global fears have to be stopped off for any decent moves to be made by the shilling. So I expect it to remain on the back foot, even if the yield play might support it.
What's your response, Duncan, to commentary that's out there that says, but raising interest rates could crowd out small and medium-sized businesses, that the current government has been struggling to support since 2002 in order to help spur growth in the overall economy?
It's true that could have an impact, but when you look at it, net-net, you're having rising inflation almost on a monthly basis. And now when you take it that we are a net importer, and even these businesses that we're talking about, a big chunk of them are importing whatever they're trying to sell. Then you add the factor that power is a key input into production and almost everything we're doing. So when we're importing in crude at higher prices, or buying the dollar to import crude at higher prices, it will filter eventually into the economy. And what we're looking at now is a complete slowdown.
Well,
and one way is to check it, pay the price on the short term, and then reap the long-term gains. Or leave it, and we will now be dealing with the consequences, which don't look good at all.